Let's bring in our friend, frequent contributor, Valley Bank CEO Ira Robbins. Mr. Robbins, welcome. Good to see you.
Wonderful to see you. Thank you for having me.
How you doing? How's the week been?
Great. For us here at Valley, it's been an amazing opportunity for us, and we've opened up a lot of accounts. Our teams have been working all weekend, 24/7, to open up accounts. Once the failure of SVB and Signature was announced. Personally, though, what troubles me a little bit is that Valley's benefit is coming at the expense of the regional banking industry. Tyler, if you recall back in 2008, 2009, we created this concept of too big to fail. And that's only been proliferated since then. My fear is on the back end of this crisis that we create something called too small to succeed, which would be a travesty for the American economy.
Go ahead.
Ira, can I ask, I actually just saw your bank's name come up on a screen because now we're getting endless screens of who has what level of uninsured deposits and who has what level of this and what level of that. Yours screened very high for growth in commercial real estate loans outstanding, obviously a big pressure point for investors right now. What can you tell us about the quality of the loans you've extended in commercial real estate? How many of them, for instance, are to office space that might be vacant? And what would you say about those who are concerned about that asset quality for the next couple of years?
Yeah, I'd say, look, every organization is different. Valley's been around for 95 years, and we have never had a losing quarter, ever, in 95 years. Credit quality and the risk management is something we don't take for granted in our organization. When you think about office specifically, we have 260 million office loans in Manhattan. That's it, on a balance sheet of $58 billion. So we do a pretty good job risk managing our overall portfolio. A lot of the growth that you see is really a function of some of the M&A that we've done over the last few years.
People are looking to follow on Kelly's good question there. They're looking at the various banks' loan books. My questions are twofold. One, are you growing your loan book this year considerably? And what about the credit standards you're applying to applicants or to existing customers? Are you tightening them?
It's a great question, and I know many of our peers, I've heard commentary surrounding tightening credit spreads, widening credit spreads, tightening standards when it comes to debt service coverage ratios and some of the other metrics that they looked at.
Right.
We may a little bit, but reality is for Valley, many of our clients sort of self-select when's the right time to be in and when's the right time to be out. So origination activity for us has declined this year versus where last year is, but it's largely a function of our clients not feeling comfortable in what they're seeing in the space today and just deciding to keep their cash and hold on the sidelines.
So, Ira, are you making any changes to your business model after the events of the past 5 days?
I think business models in banking are going to change dramatically. That said, as we think about our overall bank, we've always run a very diverse balance sheet. We bank well over hundreds of different businesses. We have never had a concentration in any individual vertical. And I think that's the success that we've had over 95 years, why we've been so successful. And I think many within the banking industry have really operated in that manner. And it's important for us as an industry to make sure that we build that confidence and trust back up.
Did you buy long-dated treasuries and mortgage-backed securities over the past couple of years before the rate hikes?
A little bit. Our overall investment portfolio is only 9% of the total assets that we have. So it's very, very small compared to what the other peers are. And we've stressed what the OCI is in the AFS portfolio and the HTM portfolio, and it's minor. That's prudent risk management. Kelly, what I see, although it's a little bit different from what it was in 2008, 2009, from a credit perspective, but it's nothing more than a crisis of confidence, a crisis of trust, right? And trust is a function of character,
right,
as well as. And in 2008, 2009, there was a lack of confidence when it came to credit. And today there's a lack of confidence when it comes to interest rate risk and liquidity risk management. And it's incumbent upon banks to make sure that everyone understands that's not true for the majority of the industry. Overall, we are wonderful risk managers. And that's just something that the industry needs to really make sure that we're communicating to all of our clients.
Real quickly, Senator Warren is talking about expanding stress tests to banks. She might have said $50 billion. I know regulators thinking, okay, maybe at least $100 billion. Remind me again what your size is. But when asked this morning about whether banks could be trusted to do their own stress testing, she sort of laughed and said, I was a professor. I wouldn't trust my students to do their own testing, to administer their own tests. What's your response to that?
Yeah, I think we do a very good job overall managing the risk within our overall industry. Look, it can always be improved. I think regulation is a good thing within our industry, but we to understand the unintended consequences of what regulation is at some point. And it's a great conversation to have, and I'm looking forward to that conversation.
All right, Ira, thank you, and thank you for being available to us as you are so frequently. We appreciate it. Ira Robbins.